Welcome to the deep dive. Today, we're digging into a very specific rules-based way to buy stocks. Think of it like a precise checklist a stock has to pass before you'd consider buying. Our source is this trading tip that lays out these exact conditions. And our mission today, really get under the hood and understand the logic behind each step.
Exactly. It's not just about what the rules are, but, why they're there. What market behavior are they trying to capture or avoid?
Okay, let's jump straight in. Rule number one. The stock has to be trading above its 200-day simple moving average, period. No exceptions.
Right.
Now, the 200-day SMA, that's the big one for the long-term trend, right? What's the thinking making this an absolute must?
Well, fundamentally, it's about filtering for stocks that are already in a established long-term uptrend. Stocks consistently above that line, historically, just tend to perform better.
They have momentum behind them.
Exactly. It suggests strength, maybe good fundamentals, positive sentiment. It's filtering out stocks that are, struggling long-term.
Makes sense. Okay, rule two narrows things down. The stock needs to be within 1% and above its 20-day SMA. Much shorter time frame.
Yeah, so this adds a layer of recent strength. The 20-day SMA, that's roughly the last month of trading.
Okay.
Being close to it and above it suggests positive short-term momentum. The stock is moving up now, but it's not like super stretched out from its recent average price.
And that ties into rule three. The 20-day SMA itself needs to be above the 200-day SMA, the famous golden cross. Why is that specific alignment important here?
So the golden cross, it's a pretty classic bullish signal in technical analysis. It suggests that the shorter-term momentum, that 20-day, is strong enough to have overtaken the longer-term 200-day trend.
Like a confirmation of the shift?
Kind of, yeah. It often points to the potential start of a more significant sustained uptrend.
All right, rule four, no resistance within 3% above the current price. Let's break that down. What's resistance here?
Resistance is basically a price level where, in the past, the stock has hit a sort of ceiling. Sellers came in, price struggled to go higher.
Okay.
So, wanting no resistance nearby, within 3%, the idea is you're looking for a clear path upwards, at least in the very near term. You don't want to buy just as it hits a known trouble spot.
Got it. Avoid hitting your head on the ceiling right after you buy.
Pretty much.
Rule five gets into candles. The previous day's candle has to be bullish. Specifically, a bullish engulfing or a hammer pattern.
Right, so these are specific visual patterns on the price chart. A bullish engulfing kind of, swallows the previous day's down candle, showing strong buying came in.
And a hammer.
A hammer has a long, lower tail. It means the price dropped during the day, but buyers stepped up forcefully and pushed it back up near the open. Both suggest buyers overcame selling pressure.
And it has to be the previous day's candle.
Yes, that's key. It indicates that recent selling pressure was likely rejected, setting up a potential move higher today.
Which leads perfectly to rule six, another non-negotiable. You only actually buy if the price moves above the previous day's high.
Exactly. This is your trigger, your confirmation. Even if everything else lines up, you wait for this.
Why wait?
It confirms the bullish momentum is actually continuing into the current trading day. Breaking yesterday's high suggests buyers are still in control now. It helps filter out, false starts.
Okay, that makes sense. Now, the last two rules are about managing risk. Rule 7, maximum loss is capped at 3% of your invested capital.
Yeah, this is fundamental risk management. Before you even enter the trade, you know the absolute maximum you're willing to lose on it. Protects your capital.
Crucial. And Rule 8 sets the stop loss using ATR. Stop loss 2 ATR below entry price. ATR is average true range.
Correct. ATR measures volatility, basically, how much the stock price tends to swing around on an average day.
So using 2 ATR for the stop loss?
It makes the stop loss dynamic. A volatile stock gets a wider stop, a less volatile one gets a tighter stop. It's trying to place the stop outside the normal daily noise or fluctuations.
So you don't get knocked out just by regular volatility.
Precisely. But it still protects you if the trade really goes against you. And again, like all these rules, it's presented as non-negotiable. Discipline is clearly the focus.
So wrapping it up, this strategy is really about stacking probabilities. Find a long-term uptrend, confirm recent momentum, check for bullish signals, ensure there's room to run, and then use very strict entry and exit rules for risk control.
That's a great summary. It's very systematic, very disciplined, tries to remove the emotion.
Which brings us to a final thought for you, the listener. This kind of rigid, rules-based approach, how might it be both a strength, providing clarity, discipline, but also potentially a limitation? could you miss good opportunities because they don't tick every single
Yeah,
box?
it's that classic trade-off between structure and flexibility, something to definitely consider in your own approach.
Worth thinking about. Thanks for joining us on this deep dive.